Good evening, everyone. I am CA Dheeraj, moderator for this webinar. We are delighted to welcome you all in the webinar organized by Continuing Professional Education Committee of ICAI. It's my pleasure to be a moderator for this session on search and seizure under GST and understanding the process of wealth creation. In a short while, we will start the seminar. I would like to apprise you about the CPE committee. As we all know, the profession of chartered accountancy is growing leaps and bounds, and its phenomenon has brought the profession at the forefront. Today, our profession has acquired an indispensable position in the business and economy. ICAI continuously aims at developing knowledge edge so that the members stand out to the expectations of the society. To achieve this objective, the CPE Committee of ICAI has been continuously striving for perfection, integrity, and knowledge, which make the word chartered accountant synonymous with excellence in service. In this direction, CPE Committee has always been proactive to the emerging needs of its members, enabling them to acquire contemporary knowledge and skills to face the challenges effectively by organizing CPE programs and providing adequate opportunities. The program for the evening is as follows. We will have two sessions of 1 hour each, and the topics are understanding the process of wealth creation in Indian economy and GST search and seizure. Our eminent speakers will talk about above mentioned two emerging areas of professional interest. I would like to invite CA Purushottam Khandelwal sir, Chairman of the CPC Committee of ICI. Short introduction of CA Purushottam Khandelwal sir is agenda. CA Purushottam Khandelwal sir is the Chairman, CPC and Vice Chairman at CMP and Career Counseling Committee at ICI. He is also the Deputy Convener of UDIN Directorate. He is having 25 years of post-qualification experience in the field of audit, direct and indirect tax, and intellectual property rights. This year, he has devoted fortifying the CPE framework and guaranteeing quality across its entire operational spectrum. And this year, major focus would be on upgrading of CPE portal and mobile app for enhancement of the branding and professional competency of the members. So I would like to request Purushottam Khandelwal sir for his welcome address.
Good afternoon, respected faculty for the first technical session and dear friend Rahul Maliwal. Second faculty, very learned, expert in the GST, Punit Prajapati ji, coordinator Dheeraj Duggad, team from the CPE committee, Payal, Pragya ji, support. I welcome in this regular seminar organized by the CPE committee every Wednesday. First of all, today ICAI has declared the result of inter and final boards simultaneously for the first time on the 5th of the month. So previously we declared both the results, but we were declared on 10th of the month, and they have again saved the 5 days. My congratulations and compliment to all these students who cleared the and who passed the intermediate examination. Here we see two rank holder. Rahul Maliwala is also rank holder and Dheeraj is also rank holder. So it's a rare opportunity to talk by rank holder to the my professional fellow brothers. This year CPE committee is dedicated to upgrade the knowledge for members on the various topic which is relevant to the profession. And today we are at the topic for our what is the process of creation of wealth, and everybody is interested in wealth because everybody they did the study for to how to earn a wealth, and none other than Rahul Maliwal is an expert in how to creation of wealth. He'll going to apply how to creation wealth, and Puneet Bhai is here to express you about the what is the of certain season in GST, because the day in day out many professional brothers are doing practice in the GST. So it's very to be in touch with the technical knowledge of the search and seizure. This year my committee is upgrading portals, and we are coming with the mobile app. We are making a dashboard where all these programming unit come and register their programs, amount will directly goes to the programming unit, and they can upload CPE directly. We are also bringing a mobile app-based attendance system. So there's no need to sign a physical attendance sheet in every CPE programs. Whenever you attend the CPE programs, you will get the OTP and your attendance will be automatically updated. So you will get the real-time update. And this year we have done that you have to do the CPE programs structure in one calendar year. So 3-year period is now no more there. So you be conscious and you have to attend the program regularly, because there was a previous period was 3 years, and there is no meaning that if we are doing work today and updated later on. So we come out with this program that you have to attend the CPE programs on the calendar year only. So I will not much take out time because the faculty is here. My congratulations to Rahul Bhai to go ahead. Thank you so much. Dheeraj, take forward ahead.
Rightly said, sir. The CPE committee is really upgrading itself as required by time, and we are fortunate enough to be a part of the institute. Taking the session forward, I would like to introduce our first speaker for the day, CA Rahul Maliwal, sir. CA Rahul Maliwal, sir, completed CA at the age of 19 years and 10 months. He is working in the area of indirect taxation and handling the litigation and appears in the field of indirect tax. He also has a deep understanding in the field of value investing, behavioral finance, and macroeconomics. He is a regular speaker at various branches of ICAI and study circles of ICAI, and delivered various lectures in industry on the proper implementation and understanding of the GST law. So I would like to request C. Rahul Maliwal sir for his address. Thank you.
Thank you so much, Dheeraj Bhai, for such a nice introduction. First of all, thank you to our Central Council member, Shri Purushottamji Khandelwal, for giving us the opportunity to explain our views with regard to this process of wealth creation in Indian equity market. Now, I'll just share my screen. So this is how that India will look like in 2050. Now, whenever we start with the process of wealth creation, we must have to understand with regard to the eighth wonder of the world, which the Albert Einstein has always said, which is the eighth wonder, that is the compounding interest. And the person who understands it earns it, and the person who does not pays it. So, if you consider a Warren Buffett, a peculiar person who has made the enormous wealth by investing in the businesses only, then you will realize that out of the $114 billion of the wealth that he has created over a period of time, over a period of journey of 93 years, out of that $110 has been created by him after 65th of his birthday. That means up to 65th year, he was having $3 billion. And after 65th year, that he has created a 11111. So our mind are not built to handle this particular absurdity. Now, I will give you one interesting fact with regard to that. We all admire Warren Buffett because he has made the enormous wealth by investing itself, but he is not the person who has compounded at the highest rate. If you take an example of a person who is over a period of more than 10 years, how many at what rate someone can generate the wealth, that is the person is the Jim Simon. Jim Simon was a hedge fund manager from the US. He has generated astonishing CAGR of 66% annually. You will surprise the 66% annually in between 1988 to 2018. So if you consider a 66% CAGR for 30 years, that means if you invest only 100 rupee, that would turn out to be 4 crore rupee or 40 crore rupees. So this amount of the wealth has been created by the Jim Simon. And if you now compare with the Warren Buffett, his roughly compounding is 20% CAGR, which is even less than one third of the what the Jim Simon has created. But nobody remembers Jim Simon because his net worth is 75% lesser than the Buffett. So what is the reason behind that? Why there is so much difference? He has created 66% CAGR, where the Warren Buffett has created 20% annually. The Gene Simon has started his investing career, he has started his journey after till the time he has reached the 50-year-old. So he got very less period than Warren Buffett for the purpose of compounding. So whenever we read or whenever we listen about the Buffett, then his skill is investing, no doubt. But the secret is time. The secret of wealth creation is time. Now, what we used to do, we always pressure or we always try to increase the R, that is the return. Means, for example, if you want to compound your wealth, we always focus on R rather than the time. So we should also focus on the time of the making investment. This is some basic example that I have prepared. If a chartered accountant who start his journey at the age of 25 and from 30 years, at the age of 30 years start investing, a monthly saving of rupees 1 lakh only for a next period of 30, that means up to the age of 60, he is investing 1 lakh rupees only, monthly saving of 1 lakh. And we are expecting a CAGR growth of CAGR return of 15%. Now, why I have taken the 15%, there is a logic behind that. I will show you after 3 or 4 slides. So a person, a CA with for 30 years, he is investing rupees 1 lakh. At the end, the CAGR return is 15%. Then the amount of the corpus that he will generate after 30th year, that means after at the time of reaching 60th year, would be approximate 70 crore rupees. This amount after earning, if he is earning the corpus of 70 crore, he would be in the population, not the population, I will say even the household, Indian household of the 1%. Because in today's scenario, not more than 1% of Indian household is having a net worth of 100 crore. So by investing rupees 1 lakh for 30 years, here the important catch is 30 years. Now let us move forward. And if assume that rather than stopping at the age of 60, he invests that particular amount at the till the age of 70. That means for additional 10 years. So for additional 10 years, he is investing 1 lakh rupees per month. That means 12 lakh rupees an annum. And 10 year means that is 1 crore 20 lakh he is additionally investing. But after the age of 40 years, the amount he will get, I think he would be under the 0.1% population of India, household in India rather than population. That is the 314 crore rupees. So the period he expand from 30 years to 40 years, that is the additional 10 year, he gets the maximum benefit from 70 crores to 340 crore. So till the age of 60, in 30 years, he accumulated a wealth of 70 crore. But for additional 10 years, he accumulated a wealth of 240 crore. So the secret of compounding is not only the rate of return, the max, it is also the duration for which the amount is being invested. Sorry for pardoning my voice is not clear. That is because of some throat infection. So now, so what the Einstein says, the person who understands the compounding earns it, but the person who don't understand the compounding pays it. Now, this is one of the classic example. If a chartered accountant at the age of 25 he cleared his CA, now from the age of 30 he started earning a rupees, assuming 1.5 lakh, 2 lakh rupees per month, and now a bank approached him for buying a house, and he is taking a home loan of rupees 1 crore. He is taking a home loan of rupees 1 crore. Now, the rate of interest we assume is 8.5%. The EMI and the tenure is 15 years. His EMI would be 98,474 rupees. So for 15 years, he has to pay 98,000 that to have a house of rupees 1 crore. But assuming another chartered accountant with the same caliber, he cleared the 25, he is also having the same salary. But rather than buying a house, he chooses to live in a rented premises, and out of that 98,474 EMI, he pays 15,000 for the renting. Now the monthly investment he has 83,000. Assuming he invests that particular amount per month in the equity market for a period of 15 years. Now for the next 15 years, his corpus would be 5 crore 65 lakhs rupees. So in the previous situation, this fellow is making payment of housing loan till the time of 15 years, from 30 years age to 45 years, and he is having a house. But in this particular situation, he has generated a corpus of 5 crore 65 lakh. So now what he can do, he can buy that particular house even by making a down payment of 1 crore. It may be probably because of inflation, the value of house would be 2 crore. But out of that, after making the down payment of 2 crore also, full payment of 2 crore also, he is having a value of 3 crore 65 lakhs spare with him. So the basic thing is that whenever you want to create the wealth, rather than rather than going for the loans, rather than making the payments of the installment, you should approach and you should go for the wealth creation first, because the time is the secret of the wealth creation. So this is the basic routine aspect with regard to the wealth creation. Now, why India is only the preferable market to create the wealth? Why not any other country? So this is how the India was in 1947, and this is how the probably the India will look like in 2047. So this is just an imagination, but this imagination is backed by some theories. Now, this is the statement given by Mukesh Ambani in 2023 that India is likely to be the $40 trillion economy by 2047 from currently $3 trillion, and $3 trillion to $40 trillion in these 25 years. And this 25 years would be remembered as the Amrit Kal for the India. So if you assume in 25 years, the India will be now from the $3 trillion economy to $40 trillion economies, then there is a CAGR growth of 7%. It is not going to be the linear one, that the 7% straight line, but there may be hiccups. But in some year it would be 3%, in some year it would be 9%, but there is a CAGR growth of 7%. Now, this is not only the Mukesh Ambani, it is being followed and it is being said by everyone, every businessman, every person, those who are investing in the India from even from the outside India, they are saying that till 2047, maybe 2050, that India is likely to be the $40 trillion economy. So in earlier example, why I have taken 15% as the rate of return. So if you compound 3%, 3 trillion to 40 trillion, it is 7% CAGR. This is the real GDP growth. Now add the inflation. If you add the inflation, that what the India is approximately having the inflation of 5 to 6%, then you'll get the return of 12 to 13%. 12 to 13% is the nominal GDP growth itself in India for next 25 years. And over and above that, if you add, the corporates will be going to do much better than the normal GDP. Then, and for that, you consider the 2 or 3% extra. There is a 200 or 300 basis point extra wealth creation. Then it would be the compounding of 15 to 16%. So the 15% that we have taken is likely to be done. And over the past 25 years also, if you consider the compounding of the Sensex along with the dividend that has been given, will be approximate 14 to 15%. So this compounding will going to carry forward, and 15% is the average rate. In case if you are investing by some doing some research in some good companies, you may get 18 to 20%. So now let us start with the why India only. So this is the Morgan Stanley research report. It says this decade is belongs to India. Why this decade is belongs to India? That the India is the condition in place for the because of the offshoring. Second, in the manufacturing capabilities. Third is the energy transition. Fourth, the biggest one is the digital infrastructure, and the fifth that is missing in this report is that the discretionary spending because of the change in the per capita. Now let us look one by one. What is with regard to the offshoring? Offshoring is the trend now that is going to follow in India, because every company with regard to the manufacturing capacity, they wants to have one setup in India. The reason behind that because first one is the China plus one due to COVID or the geopolitical issues that is going on between the Western countries and the China. Now they do not want to have over dependency on the China, and everyone wants to have one alternative, and they are going, and the biggest alternative that is available to anyone is the India, because India can absorb any such type of the investment, any huge investment that can be absorbed is by India. So for example, just to give you the example, Apple has plans to give to have 18% of iPhone production. That is the global iPhone production till by 2025 in India. And today it is approximate 7%. They started just 3 years back, and today it is 7 to 8% of the total global iPhone production is from the India. Second is the manufacturing capabilities that is enhancing. Currently, the Indian GDP, if you consider the manufacturing sector in the contribution in the Indian GDP, that is approximate 15% only. And by the end of this particular decade, it is estimated that it is going to be the 21%. We will see later on about this particular manufacturing aspect. The third offshoring is IT, and that is already in India. Our IT firms are doing the so many tasks in relation to the US, UK, and European countries from India itself. So the IT from IT we are doing already the offshoring from India. The fourth is the office and the infrastructure. Excuse me. The office and infrastructural growth now after the COVID is also increasing in India because now the companies that have the office in the Manhattan in the US, they found that even by setting up the office in India, in Mumbai, in Bangalore, in Hyderabad, they can do the work for their remote located client. They do not require to have the huge infrastructure cost outside India. So this will also benefit as a part of the offshoring. The fourth is the PLI. That is the productivity link incentive that the government is giving to maximize the production. That is the manufacturing capacities. Just to give the example, that is the Foxconn in between 1st August 2021 to 31st March 2022. During that particular period on itself, on the production of iPhone, they have claimed the PLI incentive of 357 crore rupees. So such a huge benefit and the huge incentive that the government is doing for setting up the manufacturing facilities in the India. The another reason is the reforms, be it with the labor reform, be it with the other reforms that the government is doing for having the manufacturing setup. And the last but not the least, that is the tax structure. Today we have the corporate tax structure, corporate tax rate of 15%, which is one of the lowest in the developing economies. So these all are the benefits, these all are the actions that are in place that the manufacturing as well as the other offshoring work can be given to the India. The second aspect, so this is whole with regard to the mercantile export and service export. That was I am talking about. If you look at the scenario of 2021, 2011, we were having the more merchandise export, lesser the service export. But after that, our service export, because of the IT, has increased exponentially, and the merchandise export, because of the lesser manufacturing capabilities, it is decreased. So the growth, if you will see between 2011 to 2021, in the merchandise export is much lesser than the growth in the service export. Now, what we are assuming in the 2031, that as I told to you, where the merchandise export, because of the manufacturing growth, would be very higher. If you consider that the 2021 to 2031, that is the estimated that the merchandise export from will be the 395 crore to 1197 crore. And the jump in the service export would be 240 to 682 crore. So when you look at the India's share in the export market, in 1991, the merchandise export as well as service export was what par 0.5%, 0.6% in the export with regard to the total export size. But till 2011, the value of service export has been increased exponentially. And now 21 to 31, it is being regarded that our value of export, merchandise export will grow at the rate of 12.7%, and the service export will grow at the rate of 10.4%. So the concept, the thing is that now we are placing our manufacturing capabilities, and now the manufacturing sector will see the huge growth. Second one is the digital infrastructure that has been placed. And the one of the biggest reform that has been done is the Aadhaar. Due to the Aadhaar, there has been a significant change has been done, because in the government policies also now everyone, in case if the government is giving the some incentive, in case if the given government is giving some subsidy, it is directly gone to the person who is holding the Aadhaar by way of the Aadhaar that is linked to the bank account, Jandan account. So this is the major beneficiary is the bottom of the person, those who are the bottom of the pyramid. The second one is the UPI. The UPIS formula has done the very significant work in the formalizing the economy. Then currently, if you look at the UPI transaction that the India is doing, it is approximate 26 crore transaction per day. and it is going, and our system has the capability and the capacity to handle billion transactions per day. And this UPI has being the significant change with regard to the businesses. Now, if you will go to the local kirana shop, even local vendors like the fruit seller as well as vegetable sellers, they also have the UPI in place. So by way of the UPI, whatever the money that was not coming into the circulation, now into the coming into the circulation. I'll just give you the example. Recently, I visited a village in the Rajasthan because of some family function, and I found a person of the AU Finance Bank was sitting at a kirana store, and he was analyzing his cash flows. Like, how you are analyzing his cash flows? So he said that on the basis of UPI transaction, I'm analyzing the cash flow on that particular cash flow basis. He has given the loan of 1.5 lakh rupees to that particular kirana vendor. So this is the benefit of the UPI, that it has formalized the economy. The third one is the GST, one nation, one tax. And the GST is the core of building, or we can say that is the entire concept of the indirect tax into a one tax. And by doing this, there is a transaction, there is the ease of doing business. The GST is also backed with the digital infrastructure, that is the GST and Goods and Service Tax network. And till and currently we are seeing that we are having the monthly collection of 1.5 crore rupees, and there is an estimate to increase by the end of 5 years, after the end till the end of 5 years to the 2.5 crore rupees monthly. So GST also has made a significant change in the business. The next one is the digitally changes the FASTag. Now, if I'll give you one data that now currently the India is collecting 193 crore rupees per day toll collection on because of this particular FASTag, and that has to be it has to be 60 to 70 crore only before the implementation of the FASTag. So it is the increase of the threefold after the implementation of the FASTag. So you can see what were the revenue leakage. So by having some digital infrastructure, whatever the revenue, there was the leakage in the revenue. Now it is being getting compressed. The fourth that is going to one of the aspect is the ONDC is also going to come. The next one is the OCN, that is the Open Credit Network. It will also Open Credit Network will give the more challenges and will give the more capabilities and the more. And I would say that is the larger part of the public will get the benefit of the funding because of this coming to the OCN. Now, how the digital infrastructure will change the entire scenario of the credit lending. You just have a look on this particular slide. This is the overall credit to GDP. There is a nominal GDP. Now, nominal GDP, the India FY 2012, there is a overall credit to nominal GDP was 60%. Till 2022, it is being declined to 57%. And it is estimated because of the digital infra that I have told you, because of now they have because of this UPI, a banker can evaluate the cash flows of even a small vendors, and they can give them the loan. So it is estimated that till FY32, this particular 57% will go to the 100%, and 100%, the ratio of the overall credit to nominal GDP will be the 100%, and that is the 17% jump. That is 17% CAGR jump in the credit period. Sorry, the credit amount. So you can see what the amount of the opportunity that the financial sector of the India have, and what the amount of the opportunity that the niche player, that is the small finance bank, that is the small NBFCs, those who are giving the loan to that particular rural vendors will be having. So it is going to be the one of the biggest sector of the coming decade. Now, the next one that I have told you with regard to the low per capita income. So India is today is a $2,000 to $2,200 economy per capita. This is how the our distribution of household looks like. That is a $0 to $5,000 household is 38%, 5 to 10,000 36%, 10 to 35 24%, and about $35,000 income is 2%. Now by 2031, this pyramid will change. Then a family household in between 0 to 5,000 would be the 13% only, and the family is above $35,000 would be the 7%. So there is a threefold jump in the family household, those who are having the income above $35,000. So you can imagine again what would be the growth in the discretionary spending, because whenever there is a per capita jump happens, the basic necessity, there is a no, the growth in the basic necessity, roti kapda makan is going to be the stable or slightly higher, but excess amount of money will flow to the discretionary spending itself. So summarizing this, what are the major trend for this particular decade? That India will see a GDP up to $7.5 trillion. So 3 to $7.5 trillion economy. So no real GDP growth of 6 to 7% per annum. Manufacturing sector that is going to contribute 21% in the GDP. So currently 15%. That means in $3 trillion, that is a 15%. Yani currently the manufacturing sector is approximately 450 billion, and it is going to be the 21% share in the GDP. So that means it is going to be $1,500 billion. So 3x jump in from here. So you can see there is a manufacturing companies will overall also do 12% CAGR for for this particular 10-year period. And the companies, those who are in the niche businesses, will do much better than that. Credit to GDP, as I would explain to you, 57% to 100%, 17 to 18% CAGR growth is there. And the per capita changes that we are believing that from 2600 or $25, whatever it is currently, to $5,300 in this particular decade. Now, as I told you, India is still a very poor country. Uh, in case if you look at the GDP in the absolute number, we are in the top five. But if you look at the per capita number, we are still much behind than even Thailand, which is having the per capita of 8,200. Indonesia, 4,200. Leave China. China is having 13,700 and the US is 80,000. So we are much behind even than the Thailand and Indonesia. So there is a shift which is going to be happen from the per capita aspect, will give the so much boost to the discretionary spending. Hence, the theory which plays into the India, where we can make the maximum, where we can create the maximum wealth is the underpenetrated market. So how you will find out that particular market? So underpenetrated market is here. Why there is underpenetration? First, there is a per capita income which is very much below than the $3,000. That is 2600 dollar. Credit to GDP is also very low, less 56 to 57%. If you consider China and the US, it is currently more than 150%. The credit, they have taken the credit, that is the loan to the GDP ratio is more than 150%. Only 33 companies in India currently is having the $1 billion profit, which is very less. Only and this number is very astonishing. We are very much surprised, and we are very much we say that now we are having a SIP SIP number of this in the equity market of the $2 billion every month. But if you compare with the total household saving what we have annually, total household saving is the $800 billion annually, and out of that only $2 billion is goes for the SIP. That means it is only 3% annually that will be invested by a SIP. Now, if you compare with the US, that is the pension fund, that what they have, that is a 401k, that is a retirement plan, itself get 10% of the US fund household savings. So we are still very below, and we are still very below invested in the equity market. Now, I'll just give you one example with regard to the China. This is the Indian household asset of the 2023. So this is with regard to $800 billion is the annual household saving, and this is the entire household balance sheet of the 23. If you look at the $11 trillion, out of $11 trillion, we are invested more than 50% in the property, more than 15% in the gold, and the only 4.7% of the household savings is invested in the equities and the business. In US, this ratio is more than 27%. So you can assume if 4.7% will even double in the next 10 years, what amount of the flow of money you will see in the equity market? Because currently also we are having we are having the constant fund of flow of the money through the SIP of the $2 billion. And if you look at the earlier what used to happen in the Indian market, it was being controlled by the FIs. Whenever the FIs are the selling from the Indian market, the Nifty and the Sensex used to fall 30 to 40%. If somebody would told you 2 years before that the FIs are going to sell 35 to $40 billion, which they have done in the last 2 years, then the market would definitely fall 40 to 50%. But because of the resilient flow of the money that we are getting now in the Indian market from the retail investor, from the retail savings by and the money that is infused by the DIIs. So because of that, our market is still very higher, and we have made the lifetime high when the US is still not made the lifetime high. Hence, you can assume that if the 4.7% is going to increase to 10%, then the amount of flow of money that you will see in the Indian equity market. I give you some of the China and India theory. Why I said that the why the China India is now what the China was in 2007. In 2007, the nominal GDP of the China was 3.5 trillion. What we have currently in 2022. In 2007, the GDP per capita GDP was $2,600, which is 2,500 for 400 $500 in India. Private consumption was same. So everything was more or less same what the China had in the 2007. But you look at the China from 2007 to 2011, in the 4 year itself, they have double their GDP, they have double their per capita income, and by the real GDP growth in the China was approximately 15 to 16%. And if you add the inflation for that particular 4 year, it is good. It was 20 to 21%. Can we see in the India? Yes, that can be also possible in India, but we are conservatively estimating not in the 4 year, but at least in the 8 year, it is going to happen that India will replicate what the China has done in the 2007. This is the one of the perspective that I want to give you. In 1990s, India and China used to sell equal number of cars. But look at the period after 2005, 2006 to 2007. There is a huge differences. There is a huge difference. Why? Because as I said, that is once they have crossed the limit of $2,500 per capita, now they are having the $13,000 per capita. The difference in the discretionary spending is exponential. If it had been the roti kapda makan, it has to be linear, but car sale is the discretionary spending. So can we see such type of growth in India also? It can be very well possible. So we need to evaluate in our mind, in case if the $2,500 to $5,000 India will go in the per capita, what kind of the expenditure that is going to increase, and the entire value chain of this particular business, from the car manufacturer to component manufacturer, everyone in this particular value chain will get the benefit of this. Currently, China is selling 2 crore car every year. 2 crore car every year, and the India is selling approximately 3.5 million. It is 2021 3.1 million. Now 23 it is 3.5 million. That means 35 lakhs car. So there is a huge difference in the India and China. But why the India is being better placed? What China was placed in 2007? Why we have 25-year runway? No, well, which the China was having only 16 years. Because you look at this particular graph. In 2007, when the China took a sharp jump, there was the median working age population for the China was 32.2, and currently it is 38.5. Now, when we talk about 22 23, the Indian currently working age population is 28, which the China was used to having the 1998. So till 1998 to 2022, they have the golden period when their median age was 28 to 30 years. So this 25 years, now India has the golden chance. This is why it's called the Amrit Kal, and we have the better perspective and better period of runway than the China, because the China in 2007, when they took a you took when they expanded with very drastically, their median age was 32 only. Now, so this is with regard to the whole aspect that why the India is considering to be very lucrative for next 20, not for the next 2 years, 5 years, but for next 25 years, for making the investing and for making the huge wealth. But what are the ways to create the investing? What are the ways to make the investment? So the very first basic way is to go for the mutual fund. If you do not understand the business, if you do not have the time to understand the business, the invest in the business, don't go with the invest directly investing in the equity. One of the recently, the Zerodha founder Nitin Kamath has given the statement: 99% of the people, those who are doing the trading in the equity market, even do not able to meet the active trader, do not able to meet the FD return. So if some excuse me, if somebody do not understand actually the investing in the equity market directly, they can go for the mutual funds. So you have the basically two type of the plan: direct plan, regular plan. Direct plan, there is no need for the middleman. You can directly invest with the AMC, and the regular plan, we have the advisors and that connect the with the AMC. Now I want to give us some some highlight with regard to this is the ongoing debate of the active fund or passive fund, because in US right now the passive fund is beating with the active fund. So will it going to be happen in the India also? Passive fund means those who are replicating the index. But I personally feel India is even right now also India is at the very nascent stage of the investing. As I have said, I have told you we are only making 4.7% of our annual household in the equities. So and the US is doing the annual investment of 27 to 28%. So there is a huge gap between the household assets. So when you see the money of the flow of money will come into the Indian market, I even think the active fund manager will definitely able to beat the index. So the active manager, active funds will have the better chance to beat the index than the passive fund. Passive fund actually do not beat the index because they replicate the index. They replicate the what the index, what you earn in the index. So this is with regard to the active fund and the passive fund. Now, one of the thing I want to mention, in case if you understand macro very well, then you can also invest in the thematic fund. What are the thematic fund? Thematic fund means the fund that invest in the that invest in a particular sector. So if you understand that play of the sector right now after COVID, the sectorial theme is also very sharp and very soon. So if you understand, for example, I just give you the example that Tata Digital India Fund. And those who have invested in 2018, they have done a massive they have generated alpha massive alpha than the Nifty 50, and their outperformance is very huge than Nifty 50. But those looking at this particular alpha has invested 1.5 years before in this particular fund, then their underperformance from Nifty is again very huge. So thematic fund, you need to understand the sector very well. You need to make the sector rotation very well. And when you find that now the sector is at the peak, you need to exit out that particular from that particular sector and has to invest in another sector. So those who invested in the 1.5 years before in the financial sector from exiting the digital sector has gained a most alpha. So thematic fund can be very useful for generating the alpha for beating the benchmark, but you need to be very well aware about the macros for that. Now, now we are moving towards the equity investing. So the basic fundamental is to generate the alpha, is to generate the huge wealth, is the investing in the equity. That is the investing directly in the businesses. So equity investing, what I always say, the equity investing is not about the learning, not about the mainly about the understanding the businesses. It is more with regard to the behavior and the psychology of the person who is investing. So if you need to be very well before making the investment or before starting the investment in the equities, you have to be psychologically very strong. These are the some of the framework and these are the some of the aspect that I always used to consider while investing in the equities. The first one is the behavioral finance. Equity investing is not with regard, not at all a science. It is with regard to the behavioral finance. And what the behavioral finance says to us that you should, because because human is always a social function and a social animal, and he always seeks for the social coherence and the confirmation bias. For example, if I am invested in the X particular stock, Reliance. For example, I am invested in Reliance stock. I'll look at the person, those who another person who has invested in the Reliance, and I'll match my theory with his theory. But rather than doing this, the behavioral finance in the equity says that you have to be rationally contrarian. Rationally contrarian means you should focus on the negative aspect. I'm not saying that, well, if you have invested in particular stock and you should always be think negative. No, you should find a person who is not invested in that particular stock. You should read a brokerage report who is giving the sell call on that particular stock, and you'll get the idea why they have given the sell call, and then match with your particular idea. So the behavioral finance says you always to be rationally contrarian than the what the market is following. Second, this is the biggest myth that the large cap is always better than the small cap and the mid cap. No, if you want some stability, it is not important that which cap you have invested. You are always investing in the business. Yes, in case if you have invested in the micro cap, then it would be very difficult for you to get the exit out of that particular stock. Otherwise, in mid cap and small cap also, there is no such, there is nothing like that. The large cap is always better. Yes Bank before fiasco was a large cap itself. So it is the purely a myth that if you will invest in the large cap, you would be in the safe. And if you, yes, the volatility in the mid cap and small cap will be higher than the sorry, than the large cap. But if you play a particular cycle of 4 to 5 years of the investing, then you'll get the maximum returns also in the mid cap and the small cap. The third one is the survivorship bias. Now, what happens whenever a person buy a particular stock, and it works very good for the 2 or 3 year. He he has some survivorship bias or the endowment effect with that. That he think that this stock will going to do for going to do best for him for the forever. No, but it is not like so. If you consider there is the Hindustan Motor and the Premier Auto in the 1990s, they were the only the car manufacturer or the only they were the at the top in the car manufacturer. But today they never exist. They are not even exist. So you have to be very conscious with regard to the investment what you have made. That is why it is said don't marry with your company. You have to analyze and keep check on that particular company each and every year. Evaluate the performance of the company. Evaluate the macro environment of the particular sector in which the company is working. And if you find anything negative, do not hesitate to ex- get exit from that particular stock. Fourth one is buying fear, selling greed. So everybody say if you want to make the big money in the market, then in the 3 or 4 year of the period, you will get a chance. Then the market will fall for 30 to 40%. And that would be the chance that you can create a sizable amount of the alpha. So buying fear, selling greed. But it is not work. It is very difficult to work. Why? Because there is a because whenever the market goes down, it is called a chemical that is released in our mind that is called known as the dopamine, and it says that you feel very uncomfortable whenever the market falls 5%, 7%, 10%. Then you will feel less comfortable because you think, okay, 10%, the market is down 10%, it will go more further, go down more further, and I'll invest later on. So it is the dopamine effect which tells you no, do not invest right now. Hence, you need to be very, very master whenever you are investing that buying fear, selling greed. Because what happens? Because whenever the market is going up and you are investing in that, then the odds is not in your favor. So investing is all about the getting odds in your favor because it is with regard to the futuristic aspect, and nobody can predict future very well. But at least you can make the odds more favor in you. So whenever the market is down, then what can happen is that the companies in which you want to invest will be available at the very will be available at the attractive valuations. The next one is the 100%, whether to go 100% investment or the holding cash in for the opportunity. I will always say, do not invest 100% at a time. Always hold some cash, some portion of your money in the liquid amount, liquid assets. Why? Because whenever there is a luck, then luck is what? Luck is what? When the opportunity meets the prepared mind. So whenever you find some opportunity, whenever the market is crashed, you have the chance to make the investment in it. Avoid any decision during halt. Halt means whenever you are hungry. A means whenever you are angry. L means whenever you are lazy. And T means whenever you are tired. So after in that four particular situation, whenever you find yourself in that particular situation, do not take any investment decision. And this is the scientifically proven by the US scientists. The next one is diversification versus position sizing. Diversification versus position sizing says that how many stocks or how many you can say mutual funds should I hold? Should I buy 20 to 25 stocks? And somebody says, no, 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 you should buy only five stocks. So if you are very much comfortable to buying 4 to 5 stock, you has to be very sure because in case if there is any of the stock doesn't work, then your 25% of the capital will wipe out. So the first fundamental rule of the investing is don't lose your capital. So in this particular, so I feel that whatever the investment stock you are making, you should have at least a basket of 25 to 35 stocks. So you should have a diversification. So by the way of the diversification, what will happen that in case if there is 4 to 5 stock won't work for you, then also your another stock are there to work for you. And you should not be so rigid while making the allocation that no, I should only buy 10 stocks, so 10% allocation is necessary for me. In that particular situation, what will happen to you that you will miss out the chance of making the investment in such a in those companies at the earlier stage. For example, if you find that just for an example, Zomato is good, but you are not aware with regard to the valuation, so you should start with the 2%, 3% of allocation. Even if it doesn't work for you, then also there is a loss of 2 to 3%. But if at all it works for you, then you will able to get a return of the around, you will get the benefit of that particular return. Or if you wait that no, after at the time I am making able to make the 10% of my total investment only, then I'll buy. Then you will lose out the journey of getting the wealth creation. The next is brokerage report, brokerage forecast. You must read that particular forecast, but you should not over rely on those forecasts, because what will happen that the brokerage forecast also they give for 6 months before, for some stock they have given the buy rating. In the 6 months after, you'll find they have given the sell rating. So they have a very contradictory view. Yes, you should read those forecasts to get the knowledge about that particular company, that particular industry, but you should not blindly rely on them. The next one is COC, that is a circle of competence. You should invest only on those companies which are under your circle of competence. Means the business those you which you understand. In the case if the business which you do not understand, then do not invest on that. If you invest on the basis of the logic given by any other person, that is called as a borrowed conviction, what will happen that while making the investment it is good, you have made the good entry, but you are not aware when to take exit, and where the person when the person who has given you the tip has already been exited in that particular stock. So in a stock market, entry is important, but the exit is more important. Hence, the circle of competence says you should invest in those particular stock which you understand, or the industry which you understand. And for example, if you consider life insurance as an industry, so it is very difficult and the very different than the other industry, because they have the generally companies are valued on the embedded value. They are enterprise value. They have valued on the embedded value. You have the gross margin in the normal company. They have the value of new business margin, that is called VNB margin. So they are the different at all no terminologies in that particular sector. So you need to understand that particular sector before making the investment. The FOMO, not to follow, that is a fear of missing out, and the anchoring bias means because now there is no advantage. Earlier there was used to the extra advantage of the information. Now there is no such extra advantage. Every information is going because of this social media. Every information is flowing to the whole person at the same time. So you need to interpret that whether that particular information is only the information or a noise while making the investment. So how to screen out? So this is the one of the aspect whenever you want to invest in any of the company, how to find which company is better, which sector is better. The first one is screening. This is called the screening of the companies to make the investment. One, you should look at the sector. Sector means top-down approach. Bottom-up approach can also be top-down, means you look at the macro sector. Macro sector, you go with the ladder. For example, just I shown to you that okay, in the case if the per capita income will grow, that the sale of the car will grow. So that the car you find out that yes, the macro of the in this particular sector is good, and you invest in the in the leader of that particular industry. And the bottom up approach said no, you should go with the bottom up companies which are in the niche into the that particular business. Both the investment strategies are good. The second, you should go with the clean promoters. Promoter, in case if they are into the existence, then you should go with the clean. You can have the track record. For example, in case if I talk about the Murugappa group, it is one of the most prominent group of the and the most clean group of the India. Now, just to give you an example, that the CG power was available in 2020 after the COVID of the at the rate of rupees 5 rupees per share. And when the Murugappa group, by way of the tube investment, taken over that particular entire company at the 750 crore rupees, today it is having the network, having the worth of more than 55,000 crore. That means and the share value is approximate 400 rupees per share. So it is 80x in the period of 3 years, just because that some of the Murugappa group has taken over that particular company. So you should go with the clean promoter. Accounting also you should check. There is a accounting should be clean. There are the infinite way to fudge the account, but there is only one way to write a correct account. And while making analyzing the accounting aspect, you should not read only P&L at standalone. You should give equal importance, or rather, I would say more importance to the cash flows as well as the balance sheet, because it is said that the top line is vanity, bottom line is sanity. What is important is the cash. That is, cash and bank is itself is a reality. Just to give an example, 1% Beverages Limited is the Baroda-based company. In 2018, it is recorded a highest ever profit of 118 crore rupees. But when you look at the operating cash flow, the cash flow from the operating activity was the lowest in the last 4 to 5 years. So you can easily find out, yes, there is something wrong is going on in this particular company. In 2019, it has declared a loss of 600 crore rupees. So this is the accounting is also account importance of the cash flows. Next one, you should invest on the companies where the top line growth at least should be the more than the nominal GDP. and the volume growth. You can say that is the volume growth should be the at least real more than the real GDP, because in case if the nominal GDP is itself is going 12 to 14 13%, then what is the why should we invest in such companies which are not getting such not able to cross the nominal GDP? For example, Colgate, for example, Castrol, they are very good companies. They are, but they are not a good investment. Why? Because they are growing their top line by 5 to 6%, where the nominal GDP is itself growing 15 to 16%. The next one is return on capital employed should be at least greater than 15%, because in India the cost of fund is 10 to 11%, and if you add 2 to 3% of the 3 to 4% is your that is the equity risk premium, then 15% should be at least the company should generate the ROC. That is the debt to equity should be at the lower rate. Now, should not be so high that the it will be difficult for the promoters to handle that particular company. For example, if I and in case if there is some turnaround, then it becomes the multi-bagger. For example, Usha Martin in 2000, I think in 2019 or 20, they sold off the spin of their steel plant, and the amount that they got they utilized for making payment to the for the making payment of the debt, and earlier it has to be 4 to 5 times debt to equity. Now they are with 0.2 times debt to equity, and their value of the share price rose from the it is 10x in the 3 to 4 years. So it has debt to equity should be also very well checked. Promoter pledging and pricing power. Now we do not have much time, so I just gave you the brief with regard which sectors will can do well in the coming decade. That is the one of the biggest sector is the financial sector, because we have seen 17% CAGR growth is embedded while considering the credit to GDP. So the banks, your small finance banks or NBFCs will do well. If you have the recently the Bajaj Finance yesterday has reported the 34% loan book growth, 34% loan book growth at such a huge AUM. So the financial sector will do well. Second one is the insurance. India is still very underpenetrated in the insurance, so your life insurance companies will do well. Then you have the AMC and the brokerages, but this is more cyclical business. You should be very cautious while making entry in in this type of businesses, because they will because if your entry is not perfect and you pay overpriced, then it will be difficult for you to make the money. The next one is the platform business. Platform business that can be the CDSL, and you have the CDSL, you have the MCX, you have the unlisted space. The best one is the NSC. So they are the again the CA camps. So they are the some consistent business that can be bought at reasonable valuation. Then you have the infra and the housing company. As I told that because of the offshoring, the demand for the housing is going to be very sound in India, and due to the RERA in place and due to the RERA in place, now the housing investment is very good. So housing in India is still a DLF is the biggest company with a only revenue of 6,000 crore. You will wonder that is a country with the $3 trillion company, and the biggest infra company is only having the revenue of 6,000 crores. So the time when in the coming time, the companies will grow much bigger, and it is they may have the turnover up to 60,000 crore in the 4 to 5 years, but which company will do? No, nobody knows. So in case if you want to make the play in the real estate, you can go with the proxy player like paints, pipes, adhesives, plywoods, cable, and wires. Another one is manufacturing, as I already explained, discretionary consumption because of increasing trend towards because of that's the per capita GDP growth. Defense, the Indian reliance on going on the defense, and the power sector. There is a huge opportunity that is also available in the power sector, but this is very high capex businesses, so we need to be very aware about that. So now I'm just concluding my presentation. Thank you so much.
Thank you, Rahul Maliwal sir, for providing a detailed insight on the topic and providing us with a detailed understanding on the process of wealth creation in Indian economy. It will indeed help us in understanding the process better. Now, taking the session further, I would like to introduce our second speaker for the day, CA Puneet Prajapati sir. CA Puneet Prajapati sir is practicing in the field of indirect taxes since 2005 and has a wide experience in advisory, consultation, and litigation in indirect taxes. He is also a regular speaker on indirect taxes at various forums, including chartered accountants, corporates, trade and industries, and government offices. He has also won Best Article Awards at Ahmedabad Chartered Accountants Journal for 2 times and a trophy for Best Let's Study Circle meeting from Chartered Accountants Association. I would like to request CA Puneet Prajapati sir for his address.
Sorry. Thank you, Dheeraj ji, Purushottam Khandelwal ji, my co-speaker Rahul, and ICAI, and all the audience for giving me this opportunity to share my views on the subject. Whatever the wealth you create, and however you have created, but if you face a one search, maybe of an income tax or GST, your entire wealth may be wiped off if it is not properly taken care. So let me start with my subject, and let me go through the provisions and integrities of search and related proceedings in a GST. I hope my slide is visible. Yes. Yes. In GST, there are different stages of investigation and adjudication and recovery of the tax. First of all, what happens is investigations happens. After that, adjudications happens, means so-called notice is issued and personal hearing is granted. Order is also issued. So that is called an adjudication, means quantifying the liability and ascertaining the liability, whether it is there or not. If that stage is over, you can move to an appeal, or a department can move to an appeal. And that stage is called litigation. It may go up to the Supreme Court and take the several years. And once the liability is crystallized, recovery proceeding can be initiated in the GST. So overall, first of all, there will be investigation, adjudication, litigation, and recovery. In investigation, generally inspection, access to premise, summons, search, inquiry, seizure, arrest, etc. will happen. In adjudication, so-called reply to SCN, personal hearing, etc. Litigation, appeal, and like that, and then the recovery. So all these steps, there should be some chronology. After investigation, there should be adjudication. If there is no proper investigation, adjudication will suffer. After adjudication, litigation should be there. If adjudication is not done proper, matter will be remanded back to the adjudication authority. And then after, the recovery should happen. In majority of the cases, this is the case. However, we have seen that particularly in the case of the state governments or SGST, what they does is they just start the investigation, and even before the completion of investigation, they go to the recovery. It is possible, definitely legally it is possible, but it has very limited scope. So now let me go through the one or two basic fundamental in GST or indirect tax. In income tax, what happens is there will be assessment, search or etc. Thereafter, there will be assessment. And once the liability is crystallized, appeals and everything is done, then and then only arrest will be there. But in GST or in indirect tax particularly, what happens is generally they initiate the search or they initiate an inquiry and then they arrest, and then that assessment or adjudication process continues. So that is very dangerous situation for any businessman. So during the search itself, many times officers threaten for an arrest. And this is the reason why the GST searches are more crucial or for any business houses. And this fundamental difference we should understand in GST. Now, before we move further, we need to understand that in 2017, Supreme Court, in the case of Justice Parth Swarthi, Supreme Court has decided that privacy is a fundamental right. So if privacy is a fundamental right, it cannot be taken away by the government or officers easily or without strict procedure follow or without proper law and authority under the law. Any search is nothing but intrusion into a privacy of a one person. So if there is an intrusion into a fundamental right, all the procedure prescribed under the law must be strictly followed. If it is not so, later on court will take it very seriously, and it may happen that merely because of some procedural lapses on the part of the department, entire search proceeding will be held invalid, and so the demand itself. So we need to understand what are the powers and procedures available to the officers for the search. There is one section, section 71. Under section 71, there is a power to access the business premises. So officers are always have a power to access your premises under section 71. There is another section, section 67, subsection 1. Under that, officer can inspect the place of a business of a taxable person. And section 67, subsection 2, under that, an officer have a power to search and seize the goods liable for confiscation or useful documents. So, to enter any premises under the GST law, these are the only three sections under which an GST officer can enter into your premises. I am not aware of any other section under which an GST officer can enter your premises. So we need to understand that all these sections properly, and if that visit of the officers is not under any of this section, that entire entry of that officers can be challenged. Section 71 is general access for normal power to access the document or your books of accounts or your records. For example, departmental audit. Then another is an inspection. Under certain circumstances, a joint commissioner can order an inspection of a particular business premises. We will see. And if there is a chances of an evasion, joint commissioner can also order for search and seizure. So let us see all these provisions thoroughly. Under section 71, any officer under this act authorized by the proper officer, not below the rank of a joint commissioner, shall have access to any place of a business of a registered person to inspect books of accounts, document, computer program, computer software, whether installed in a computer or otherwise, and such other things as he may require and which may be available at such a place for the purpose of carrying out any audit, scrutiny, verification, and checks. So we need to understand why these powers are given. We can see that access is possible only after an authorization by the Joint Commissioner, meaning thereby a superintendent without authority of anybody cannot directly enter to your premises and say that, no, sir, I want an access of your books of accounts, or an inspector cannot come to your office and say that, look, I want to check it. No, they do not have a power unless such an entry is previously or priorly authorized by the Joint Commissioner. So any superintendent, inspector, or an state officer cannot enter your premises without a specific authority by the Joint Commissioner. What they can enter? They can enter the place of a business of a registered person. So if any person is not a registered person, suppose a person is not a registered one, in that case, any officer of the GST, including the Joint Commissioner himself, cannot enter into a place of a business of any person, provided he is not a registered under the GST law at all. So by reading of this section, we can understand that it is the general access available to the officers for verification, like audit, scrutiny, or say whether your business is going on properly or not. So under that, it is a general power. They can come and check. That's all. Now, section 67, subsection 1. Now it is so serious. Unless there is a reason to believe, there cannot be the inspection. What should be the reason to believe? He should have some reason to believe that some tax has been evaded. So unless there is a doubt of an evaded or a tax evasion or malafide intention is there, these provisions cannot be invoked. Similarly, under the search and seizure. So under section 67, when it operates, a taxable person has suppressed any transaction. When there is Joint Commissioner has a reason to believe that the particular person has suppressed any transaction or any goods, only in certain circumstances, an inspection should be carried out. In that case also, the Joint Commissioner should authorize in a writing. And what is the purpose? To inspect any place of a business. In earlier section, that intention was to carry out audit, scrutiny, verification, etc. But here in this case, the purpose is to inspect a place of a business itself. So under section 71, verification of a books, they can enter, but under section 67, they can enter to inspect the place of a business itself, not only the books of accounts, but they can inspect anything which is there in the place. Place of whom? A place of a taxable person, not necessarily a registered person. So an inspection can be carried out of a person who is a taxable person. Under section 102 of this section 2, subsection 107 of the CGST Act, a taxable person means a person who is a registered person or a person who is liable for the registration. So not only the person who is registered, but also the person who is not registered can also, his place can also be inspected. Now section 67, subsection 2, search. Where the proper officer not below the rank of a Joint Commissioner, either pursuant to an inspection carried under subsection 1, meaning thereby if there was an authorization for inspection only, during that inspection, something new came up and they want to go further, or directly or otherwise. Correct? In any of the situation, if JC has a reason to believe that any goods are liable to confiscation, or documents or books or things which in his opinion shall be useful for the relevant proceeding are secreted at any place, he may authorize in a writing to search and seize such a goods or documents. So search can be directly initiated or may be the result of an inspection itself. First. Second, search should also be pre-authorized by the JC himself and not below the officer who is the rank of a JC. Further, what can be seized? Goods or documents or things can be seized. Please understand that immovable property is neither goods nor books nor things, so it cannot be seized under the 67 subsection 2 during the search. So now let us move to the difference, or let me summarize the difference between all these things. Access, intention to carry out an audit, scrutiny, verification and checks. Inspection is being, access. Inspection generally is to inspect the transaction which may lead to the tax evasion, and search is to find out the seized or secreted goods or article. There is no requirement or not even a reason to believe evasion of a tax for an access of a business premises. However, if inspection or search, government want to conduct inspection or search, there must be reason to believe the evasion of a tax. What can be accessed? Any business place of a registered person can be accessed by the officer. However, inspection of any unregistered person is also possible, and search is also possible. I think there is some error over here, but inspection can be carried out of any unregistered person if he is liable for the registration. Seizure of goods, not possible during the access. Even under the inspection, it is not possible unless there is a specific authority for the search and seizure under 67 subsection 2. During an access, they cannot power or a break or a seal, meaning thereby if you don't give them the key or a password, they cannot do it, or they cannot snatch it, they cannot break it during an access, but during an even during an inspection. But during the search, yes, they have a power. If you don't give them an access, they can break any lock or a password. Now, reason to believe any search or a seizure is must be followed by the reason to believe. Reason to believe is a very subjective word. It can be have a different meaning for each and everyone. But during the past, various courts has established the various concepts regarding reason to believe. Even the CBIC has issued some instruction wherein how that reason to believe should be interpreted. So there are some fundamentals regarding the reason to believe. Let us go through one by one. Reason to believe merely in a mind is not sufficient. It must be recorded in the writing before starting of a search. So it will be the responsibility of the Joint Commissioner to go through all the facts and the documents available with him. And based on that, he should have a reason to believe. And that is not enough. He should also put it on the paper. It is definitely that reason will not be informed to you, or it will not be conveyed to you during the search proceeding, or unless the so-called notice is issued. But it must be available on the file, not after authorizing the search, but before authorizing the search. Such a reason to believe must be based on some documentation or document or evidence which is which may lead any humankind to believe that there may be some evasion of a tax. Merely an assumption of an officer is not enough. Such a reason to believe must be based on some material or evidence which suggests the evidence, which suggests evasion of a tax. Now, how that many of you may not have attended any search, but let us go through the procedure during the search, how that search proceeds. Generally, what happens is when the search starts, generally a chartered accountant or a legal advocate is not available. But if requested, they generally allow a regular chartered accountant or an advocate to enter into that. If you can help them, or you can work as a bridge between both the party, taxpayer and department, because department know the law but do not know the business, and businessman knows the business but do not know the law. And chartered accountant, being knowledgeable for both the things, can help for peaceful conduct of search. So generally they allows. So if it is allowed, you can definitely be helpful during the search to the department as well as the taxpayer. So what is the steps, how it proceeds or how it goes further? First of all, investigating officer gathers the information, maybe from his personal sources, or maybe conveyed by their higher officer or other department. Based on that, he starts the investigation. At this stage, he don't share any information with anybody. Thereafter, if he believes that there are some chances for evasion, he will go to the Joint Commissioner, explain his case, and will get the authorization from the Joint Commissioner. That authorization is required to be issued in the form number INS 01. Once the authorization is received from the Joint Commissioner, generally Joint Commissioner don't join the search proceeding. Definitely he can, but generally that Assistant Commissioner, Deputy Commissioner, and the team thereof, including superintendents and inspectors in the central government, start these proceedings. With authorization, they generally arrive at the place, and first of all, what they have to do is they will show you that form number INS 01. They will identify themselves. They will show their identity card and everything, and they will inform that person, whoever is found at that particular place, that they are starting the search under section 67, and they will also show the form INS 01 to them. Definitely a copy will not be given to a person, but it will be shown to the person who is available at the that particular premises. Generally, they start talking with the person who is in charge of that particular premises, and they will call for him, and they will start conversation with that particular only. Once, before they enter into the premises and start that proceeding, it is compulsory for them to offer the personal search of an officer themselves. Why? Because later on, no one can doubt that, sir, this document or goods do not belong to me, but it is possible that you or your officer has brought such a material or document with you, and this is not pertaining to me. So to avoid such a kind of a thing at a later, it is instruction given by the CBIC that an officer, first of all, should offer their personal search to the person or in charge of that particular premises. After showing an INS 01 to particular person who is an in charge of that particular premises, signature should be obtained on that particular warrant. I am repeating it again. Copy of INS 01 is generally not being given to any person, but only signature will be taken as an token of an acknowledgement. It may happen that generally what happens is you are registered at a 117 so and so building, but but they have written 116. They may not be aware that you are sitting at a 117 also as a 118 and also at a 119 of the same building. So please understand that if these INS 01 is a premise specific, if INS 01 is issued for any particular premises, entry into that particular premises only is possible if you have similar or another offices in the same building or another building. They cannot enter into that another building for which they do not have an INS 01 or a search warrant. So if during the search they found that you also have another offices in the same building or another places, they will also have to obtain INS 01 that for that another premises immediately. So they will generally get it on a fax or now on a mobile or a WhatsApp. Yes, once they enter, they have an access to Almira, means books, bookshelf, electronic devices, box, etc. They can go through it. They can force you or they can ask you to open that. If you are not opening it, they can break it. So it is highly advisable that during the search, you should not enter into such a bravery or resistance. Rather, you should cooperate with them. You should let them open it. You should provide the keys and you should cooperate them. Now, if during the search itself, it may happen that they want to record the statement. Generally, statement will be recorded during the search. If some evasion is found during the search. So what they generally does is they will record the statement during the search itself. They will issue a spot summons at that particular place itself. And after issuing the summons, they will record the statement of the concerned person over there and they will get it confirmed or acceptance by the person concerned that there is an evasion of a tax of so and so amount or approximate of that particular amount. During the search itself, we have seen that department officers are forcing for spot recovery, but now even CBIC has told that spot recovery is not a good idea and it should be avoided. However, if assessee is ready to pay, and generally, if assessee is ready to pay, they pay it even before the searching officers leave the premises. If during the search, if any material, goods or document, which according to them are liable for confiscation or document which can be helpful in the further proceeding, they can seize any such a goods or documents. If such a goods or documents are being seized, they will issue one seizure report, that is an INS 02. In that, they will list out each and every document and goods which are being seized during the particular search. If seizure of any goods is not possible, they can also issue an order of a prohibition, meaning thereby, suppose 30 kilo of a row, some material is being found by them, which is liable for confiscation, and they are not able to get it or bring it along with them. They will issue an INS 03 prohibition order, and once it is issued, even if that goods is available with you, you cannot deal into that goods in any way before without their permission. Once the search is over, a panchnama shall be recorded. Panchnama is nothing but an entire story of a search from starting to an end. How it has happened, how they came, what has happened, your recording of a statement, what is found during that search, and how it is concluded. Copy of a panchnama will definitely given to you, and copy of a statement generally the officers don't give. So after completion of an search, an assessee will have a copy of a Panchnama, but will not have a copy of a statement generally. Before leaving the premises after the search, officers one again should offer their personal search so that it is clear that they are not bringing any material with them which is not there in the Panchnama, so that any assessee don't charge them with such an allegation in the future. Now, during the search, what should be some guidance or procedure or instruction which is available by this, which is prescribed by the CBIC. Let me just summarize that. DIN number, document identification number, is must for any document for a search which is being issued by the CBIC. Please understand that DIN number can be verified online at any time. So even if someone comes to you and showing that search warrant without DIN, that search warrant is not valid if it is pertaining to central government. For state government, although it is recommended, but many of the state governments have not started the DIN number, putting a DIN number on search warrant or any other documents. But if it is a CBIC or a central department, in that case, DIN number is a compulsory and you can verify it immediately after it is issued. I already have discussed search should be only at a place for which INS 01 is issued. If, for example, residence of a director is not there in INS 01, search cannot be conducted at a residence of a director. If search is at a residence of any premises, lady officer must be accompanied. Punch who are going to sign the Panchnama must be independent punch. And in many Panchnamas, I have seen the drivers of the officers are signing the Panchnamas, but I think it may be create a doubt on independence of the punch, and by that authenticity of the Panchnama or search itself may be created by the party in the future. Signature on the search warrant, definitely I have discussed it. Panchnama shall be made. If the sensitive premises is involved, videography is also instructed by the CBIC. Officer must make it sure that the social or religious sentiment of any person is not hurt during the search. Children should also be allowed to go to the school. Definitely, government don't trust even children. So the guideline says that only after verification of bag. Copy of a Panchnama must be given to the party. Copy of the statement may be given, but generally it is not being given. Now we need to understand the cross power of the central and the state. In GST, it is a unique situation that the single transaction is being taxed by the state and central. So in such a case, what happens is that your jurisdiction is with the state, and in such a scenario, doubt may be there that whether a central can come and conduct the search or seizure. So please understand that there is no doubt, even if your jurisdiction is with any government, another government can come and conduct the inquiry, investigation, or search and seizure related procedure. But yes, section 6 subsection 2 clause B says that if an investigation or inquiry is being initiated by any one government, another government shall not initiate such a proceeding. So there will not be a simultaneous proceeding by the central and state. So if, for example, for bogus billing of a particular supplier is being investigated by state government, a central government cannot come and ask for the document or start an inquiry for the same party or same supplier for the bogus billing. Definitely, for a different party or a different period or a different issue, and another government has also simultaneous power and can do it, but not for the same issue, same period. Now, it may happen that your jurisdiction is with the State Department, but the search is being done by the central government. So under that scenario, what will happen about the so-called notice which is being issued based on such a search, or any proceeding which is based on such a search? Fortunately, after GST Council has issued an office memorandum dated 19th October 2022, and now it has been clear that so-called notice will be issued and adjudicated by the authority who has initiated the proceeding. So even if your jurisdiction is with the state, but the search was initiated by the central government, in that case, your so-called notice will be issued by the central government, and you will be answering that so-called notice to the central government. And it is well accepted that if an order is issued by the central government, you have to appeal before the authority of the central government only. So this is very clear now. So even if your jurisdiction is the one government, the final so-called notice and adjudication will be held by the authority who has actually conducted the search. Periodical so-called notice may be issued by your jurisdictional central government, meaning thereby, for example, search is conducted in the July 2023, but a similar issue is also there after the July 2023, and you are still following the same procedure, and government want to issue the so-called notice for the period after the date of a search or a date of so-called notice. In that case, that so-called notice is nothing but a periodical so-called notice. That periodical so-called notice can be issued by the State Department or your jurisdiction local department who has an authority over your jurisdiction. Now, what can be seized during the search? Section 67 subsection 2 says the goods, documents, or books or things can be seized. So if anything is out of it, we can argue that that cannot be seized. Before we go into the seizure, we need to understand what is the difference between the detention, seizure, and confiscation. So what is the detention? Detention meaning thereby, suppose you are moving goods and an officer want to check it. So he will say, sir, please stop your vehicle, wait for a few minutes, I am checking it. By that time, you please don't move. So it is a detention. Technically, it is called a detention. The goods are mere being stopped for some verification or some procedure. It is merely a detention, nothing more than that. Now, after verification, if it is found that these goods have some importance or may have evasion of a tax, in that case, officer can tell you, sir, now let me seize the goods, meaning thereby I am seizing these goods. You may go home. I am giving you a certificate that these goods are seized. So you go home. I am not going to allow the further movement of the goods, and these will be under our control and possession. So under detention, possession was with you only. In seizure, the possession will be there with the officers now. Even during the seizure, although possession is with the department, it is the property of the person who owns the goods. So that is the second stage, seizure. Detention, seizure. Now, if such a goods are liable for confiscation, in that case, officer can confiscate such a goods, meaning thereby, if any confiscation is done, that goods becomes the property of the government. Now you are no more owner of the property. So once this confiscation is done, not only possession, but the ownership also goes to the central government or state government, whoever has confiscated the goods. So detention, seizure, and confiscation. All three are different words. We cannot use it as a synonyms. No, they are not. So when the law says or officer says that I am detaining the goods, meaning thereby he is stopping the movements of goods for some verification. It may take few hours or a day, but it will be released without any further proceeding. If it is a seizure, meaning thereby officer is taking the possession of you from you, he is saying, sir, you may go home. I cannot allow you to move these goods. Now it will be under our possession until the proceeding is over. After an inquiry, if it is found that such a goods are liable for confiscation, he will pass an order for the confiscation, and once that order is passed, it will be the property of the government. So in seizure, you lose just the possession. In confiscation, you lose the ownership also. Now, can the cash be seized during the search or any period thereafter, or under Section 67, subsection 2? We have a recent Delhi High Court judgment of an Arvind Goel versus Union of India. In that case, government High Court has nicely interpreted this provision and has held that cash cannot be considered as a thing. Cash is neither goods nor services. It is not a document. It is not a book. And it is not even a thing. Court says that cash cannot be have an importance for the further investigation. So if there is a case, cash, it cannot be seized by the GST officer under the GST law. So we have a good judgment, and Gujarat High Court ordered to return this money, entire cash, to the Mr. Arvind Goel immediately, even if the proceeding was pending. We have seen that once the search is concluded, people think that proceeding is over. But we need to understand that, particularly if you are a chartered accountant, you need to understand that end of a search is a starting of a proceeding. Once the officers leave the premises, proceeding is not over. They have to prepare many documents. They have to start the investigate. They have to go through the papers they have seized. They have to collaborate it with the other documents and evidences they have gathered. They have to ascertain the liability. They have to quantify the liability, and they have to make it sure that recovery is done. And if recovery is not done, they have to make it sure that so cause notice is issued. So it is a long time. Generally, 2 to 3 months to 6 months or 3 years or 2 years is being taken by the different authority after the search is over. And here our role starts. Even if you are not present or you are not allowed to be present at a search, officers generally allows you after the search for representing your client, and they accept the documents from you. And they also allow the clarifications to be submitted by you. What happens is generally they issue the summons after the search for gathering the information or recording the statement, and assessee has to be there. You can, if the officer allows, you can accompany them, and you can make it sure that nothing wrong is written in the statement. So here our role starts. Once the quantification and clarifications and submissions are required, we can prepare it, we can draft very well, we can gather the information, we can explain them how the tax is payable, how the tax is not payable, we can discuss the law, we can discuss that current situation. We can draw the attention towards the circulars and case laws or some interpretation, advance ruling, etc. We can also provide that evidence or documentary evidences post search. And thereafter, the quantification I have during that my experience of 17, 18 years, I have understand that quantification is a very important part, and the chartered accountant plays an important role for in quantification of a liability after the search. As the time we have a limited time, I will not go through the detailed provision one by one, and I will just take upon the issues. Are the officer has any power of a police officer during the search? The answer is a big no. Court has constantly held that GST officers are not police officers. They do not have a power of a police officers. They cannot use the force. They cannot force you. They cannot manhandle you. We have seen that in many cases, taxpayers has alleged manhandling, but it can be proved boomerang for the officers if it is found that they have manhandled the cases. We have a number of cases in which High Court has taken this very seriously. So manhandling is not possible during the search or even after the search. There is no such a provision in the GST law. Is the spot recovery possible? The answer is a no. There is a big no. Earlier we have seen that, or even today we are seeing that officers are wait a minute, please. So there is no mess. Spot recovery is not possible during the search. We have CBIC circular also, instruction also, which says that there cannot be the recovery during the search. Still, we have seen many cases during which state or central government officers has forced taxpayer to pay certain money during the search itself. There is one interesting case in a Gujarat High Court, a Bhumi Associate, in which it is said that even if taxpayer is ready to pay during the search, officer should guide him that you please pay only after we leave, so that you can have a time to think over it again and you can take an advice of any consultant and decide to pay. So even if a taxpayer is ready to pay, it is now officer's duty to ask them to wait till the search is over. And it is not the Gujarat High Court only, but I think there is a Karnataka High Court of in the case of a Swiggy. Swiggy has some different name, official name. I think it is a BUNDL something, Bundle Technologies. Yes, Karnataka High Court. In that case also, Karnataka High Court has held that during the search there cannot be the recovery. So spot recovery is not allowed. Similarly, I think Rajasthan High Court, we also have a Dhariwal Products, Madras High Court, Sri Nandi Dal, and Delhi High Court, I think Vallabh Textile. So, interestingly, Delhi High Court in Madras High Court, Vallabh Textile has also ordered to refund this money along with the interest of a 6%. So whatever that amount was paid during the search was asked to repay with the 6%. So not only one or two high court, now we have, I think, 5 different high courts judgments in a GST itself, which says that there should not be any spot recovery during the search. So this is well settled principle. I think now there should not be spot recovery. Yes, there are some judgments which says that merely long time of search is not an harassment. Long time is generally not being taken by the central government, but the state departments, particularly in the western part of India, I have seen what they does is they come at 11 o'clock. At 6 o'clock, they go back by sealing the department, that sealing your premises or some cabin of your account department. Then they go back, and then another day morning they will come, and again they will go back at 6 o'clock, and they will not come on a Friday, Saturday, Sunday, or whatever. In many cases, I've heard that they don't come for 4 or 5 days, and they again come after 6 days after sealing, and they again start the search proceeding. So it is really an harassment for any person if your search is being prolonged for 10 days, 15 days, and you have no access to your books of accounts or your goods. So definitely you can go to the High Court and ask them to conclude this proceeding as soon as possible. 10 days or 15 days is definitely not required for any search, but they are using it as a tactic for recovery, and they also don't take it seriously. They start at 11 and stop it at 5, 6, and they come at whatever time convenient for them. They just seal the premises and go, and they come back again, and it's like that. But we have unfortunately some High Court judgment which says that merely prolonging the search is not an harassment. Definitely, if you have a fit case, you can go to the High Court, and I think it is not a standalone case, or it is not a precedent kind of a thing. So you can go to a High Court and can stop such a nuisance. One interesting case which came to our knowledge is that in some part of the country, what happens is under that section 129, they have a power to stop any vehicle during the movement. So what they does is, in some part of the country, some officers has followed the transportation, and once the transportation is stopped at any factory and goods was being unloaded, they entered into the premises and they wanted to seize the goods under section 129 and not under the search proceeding. So Allahabad High Court has taken this matter very seriously, Mahavir Polyplast, and has held that section 129 cannot be used for inspecting a search. So once the movement of goods is concluded, section 129 do not have a role to play. Officer cannot start the search proceeding of a premises in a pretext of the inspection of a goods during the transportation. Role of a CA I already have discussed, but there are one or two few things I will like to bring into the knowledge of the members. Please understand that, as I discussed, there are 4 stages: investigation, adjudication, litigation, and recovery. During an investigation stage, there is no charge sheet, there is no any allegation on the assessee, so there is no right of an assessee to be represented by any legal representative. No. If officer don't allow you during the search, you cannot force that officer that no, he is your client, or even a client don't have a right to allow your entry during the search. And this is so with the advocate also. But if there is a manhandling, or if there is a chances of any wrongdoing, in that case, only court can allow presence of any advocate during the search or a recording of a statement. But that too, it is well settled principle that court will allow such a presence during the search or a recording of the statement only from the audible distance, only from the visible distance and not an audible distance. So advocate can remain present during the search or recording of the statement. He can see the recording of the statement but cannot hear what is going on. So he can make it sure that there is no manhandling of his client, but he should not be able to hear anything what is being recorded and what are the questions being asked to the taxpayer. If you are lucky enough to have a presence during the statement, what you should do is you should refrain, or you should ask your assessee to refrain from doing a confession. Yes, or but statement should be recorded if it is an admission. So what is the difference between both? Admission is nothing but an acceptance of a fact. Now suppose a premises of a person is being searched and it is found that there is a 10 kg of the goods which is short. So during the recording of the statement, there are two options. First, you may write that there is a 10 kg of a shortage. So it is an acceptance or an admission. Alternatively, you can write that there is a shortage of a 10 kg of the goods and that is sold by you without recording it to the books of accounts. So it is the confession. So merely admission should be done and not the confession to the extent possible. Correct? So this is the difference between the confession and admission. Once it is a confession during the statement, you cannot do anything later on. But if it is merely an admission, later on you can able to argue that, sir, I admitted that there was a 10 kg of the shortage, but at that time I could not remember that. I could not recall that there can also be a production loss of a 10 kilo. So that may be the reason of a shortage. So there is nothing like a selling of the goods without recording it. But if the statement is recorded as if it is a confession, it will be very difficult for anybody to prove it otherwise in the future. Please understand that a person who has searched the premises or officers who have searched the premises will not be a person who will be handling your adjudication of the so-cause notice which was resulted due to the search proceeding. So person who is doing the search and concluding the investigation will be the different person, and the person who is going to adjudicate this matter will be the different authority himself or a different person. So whatever fact you are giving to them not necessarily will be conveyed to the person who is going to finally adjudicate the matter. So it should be our duty to put everything on the writing during the stage of investigation itself, so that on the later on, when the adjudication of the so-cause notice or appeal will be heard by the different person, you can always say that, sir, this fact is not new fact I'm bringing today, but this was also conveyed to the adjudicating person who was conducting the search. So this is how we should take care of all these things. Spot recovery, I think already have discussed the Bhumi associate. I also have discussed this. Another important issue is, or which can be helpful, is, which I think many of my friends do not know, is that now it is a well settled principle that a cash credit account cannot be seized. A cash credit account cannot be seized. In many instances, government has tried to seize this CC account, but now it has been taken by this High Court very seriously. In case of Ramesh Chandra Agarwal, Gujarat High Court, court has taken it very seriously and has said that earlier also they had stated that CC account cannot be seized, and even after holding so, in many cases, officer has tried to seize the CC account and they hold the officer personally responsible for that and ask them to remain present during the next hearing. So this can be helpful to us if we have a knowledge that a CC account cannot be seized. You can directly approach to your bank, and you can bring this to the knowledge of the bank, and without going to the department, you can force your bank to release the account that he may not be aware or officer may not be aware about the law, but being a bank, you have a legal law department which should be aware of it, and CC account cannot be seized under the GST law. So this is the many issues. I think I am done with my time. So thank you very much, everybody, for your patience hearing. And thank you very much, ICAI and Purushottam Khandelwalji and CPE committee entirely for giving me this opportunity to share my views on the subject. Thank you very much.
Thank you, sir, for providing a detailed insight on the topic GST search and seizure. We have one question from the audience. The question is whether inspection authority has the power to verify mobile phone records of the proprietor or manager.
No, not at all. If that search is that access is under section 71, they do not have a power. So first of all, if they are asking for it, you should ask for the INS 01 being an authority. If INS 01 is issued under section 67(1) only, you should not give them. You can simply deny that, sir, this is my personal property, I will not allow. Correct. But if authorization is under 67 subsection 2, then definitely you are supposed to give them. They will seize it, they will bring it, they will take it with them, they will record it in the Panchnama. Definitely, they can also send it to the forensic department and get the information out of it. So, but yes, during an access under section 71, they cannot do it. No.
Thank you, sir. So I would like to extend a warm thanks to the faculty CA Punit Maheshwari sir for his detailed insight into the topic GST search and seizure. And concluding the session, I would like to extend thanks to all the audience and also to the CPE committee and also to CA Purushottam Khandelwal sir for organizing seminars on the much needed and needed topics for the CA fraternity. Thank you, sir, and thank you, everyone.
Thank you very much. Thank you, everybody.